Okay, hi everyone. This is a video presentation of the mini greedometer and how it works. There are several other videos on the website showing mini greedometer sequences and how it works with the SPX or with the S&P 500. I'm going to go through this relatively quickly because, well, it's a video. You can stop it, you can pause it, or you can rewind it, that kind of thing. But the basic nomenclature I'll introduce on the video, and I'll explain how the system works, how the mini greedometer works at least, in this video. And there are, as I say, there are other videos on the website that apply the greedometer and the mini greedometer to other sequences. So on with the show. This is what we're looking for. There are the basic structure and setup is, well, let's see, you've got the SPX weekly close readings in blue. That's what this is. You've got the mini greedometer time series sequence values in red shown on this graph, on this chart. And what's of interest, what we want to know, and what the mini greedometer sequence tells us, is where are these inflection points? Where are the points in time where the SPX is going to invert and change direction during a crash? That's what this system attempts and largely does. The nomenclature is, well, there's the sequence birth point, there's the crash initiation point, there's the first baseline point, and then there's the other second, third baseline points. This is the first top line point, this is the second top line point, etc. And you just keep getting more top line points and more baseline points. So the top line is shown here in gray, baseline is shown here also in gray. These are near parallel, well, these are somewhat parallel lines. They're actually a bit of a funnel. The slower the crash, okay, in general, the slower the crash, the bigger this opening is, the flatter the baseline is, and the less frequent these gaps are in the baseline and top line inversion points. Okay, so that's the basic structure. You can see in 2007. Let's walk through it. How you use the system is you need to see the first baseline point. The sequence birth point. You need to see the first baseline point, and then follow the SPX into a sucker rally, and basically the SPX retests its previous peak within, in this case, 1.5% on a weekly close basis, and 1-2% of that magnitude, and look for the mini greedometer to run out of breath and then begin to roll over. When you have this set up, then you can begin to, at least I can, because I've seen enough of these, know, well, I know what this is, and I know what this is, therefore I pretty much know what that's going to look like. Now I'm at this point, I'm off to the races. I know how to play this, which is, well, if you want to profit, be short here, be short here, be short here, be long here, long here, long here. Okay. Now, as you'll see when we walk through this system, what this system does is it is not a price-driven system. Price of the SPX is not one of the inputs, and neither is it what I would call a static system. There are no magic numbers, where 1500 was something magical and 800 was something magical, and 810 meant something magical, but 800 didn't. Things like that. Those sorts of systems have been steamrolled quite a lot over the last 10 years or so, because it basically, those are stop hunting points for algos to basically overrun. So this system isn't static. It has no magic numbers. It is decidedly dynamic. So what I mean by that is, if a central bank decides to raise or lower interest rates, or what I call drop more sugar bombs, which is some sort of supportive policy to really designed to stop the stock market from crashing, then that is impacted. It's picked up in the mini greedometer, and it plays out in terms of impacting the steepness or shallowness of the baseline and the top line. So we'll get to that when we walk through this over here. So on with the show, right? So we're walking through this system. By the time we got to October of 2007, you should have at that time been able to, if you had this system, you would have recognized that This was a sucker rally. This 10% drop and 10% bounce back, plus or minus, this is a sucker rally. The SPX was retesting the previous peak. The Greedometer made it clear, and the mini Greedometer showed you all this. You got to this point, you should have said, yeah, this is the beginning of a stock market crash. Okay. How to play it, again, probably should have been short or building up hedges. If you had to be long, you should have been building up safe havens and building up hedges as much as possible. Walking through this, many of you will remember that Bear Stearns blew up in March of 2008. That's what happened. That's basically visiting the baseline here. Back to the top line we go over the next couple of months to May of 2008. Another inversion. We should be getting short and expect to be short for about half a year, plus or minus. The next baseline point, had the Fed not bailed out Fannie and Freddie and AIG, and I think at the same time some car companies and a bunch of other goodies, had that not happened, probably the baseline would have been visited. Another green circle would have been showing about here, and you would have seen the SPX just basically falling like crazy, far, far lower than, what's this, 1200? It would have been probably closer to 800 to 900. It would have been in free fall, jagged and free fall. And we would have seen a baseline point there. But they did bail out AIG, and they did bail out Fannie and Freddie. So what we began to see, we would have began seeing setting up to see the baseline warping flatter. But this wasn't all the ammunition that was required. So we continue with this, and we're out to here. This is when the Fed initiated QE1 in November of 2008. So that basically put another stopping force in terms of that leg of the drop. Even had they not, probably the baseline would have been seen about here, maybe a little bit shallower, reflecting these actions, but around here-ish in time, and it would have been absolutely in free fall. As it is, it dropped to the 800s, but as you can see, that's nowhere. The mini Greedometer is nowhere near this baseline, right? As it's set up here, it's being supported, very well supported. You should have expected, being kicked from here to probably here, maybe marginally shallower. You know what? With the SPX and the 800 hitting 800 there, with QE1, had that not happened, the mini Greedometer would have dropped like a rock over the next week, maybe a week and a half to 2 weeks. Would have seen the baseline there with the SPX 600s probably. That's what I've commented here, and would have bounced a bit more and then drop more after that. But we had this bailout, we had the announcement of QE1, so there you go. Back up to the top line we go. It spends a week there and climbs a little further. Why? Because it had all of these goodies here and here, and this is what I call a warping of the sequence. What I mean by that is warping, in this particular instance, warping flatter. So envision these two lines being pulled or rotated or warped flatter. That's what this line is. I'm showing this warping flatter. My estimated baseline would have been that. So it's, it was not in play here in time until here when they launched QE1. That was my estimated, now slightly flatter baseline, and that's my estimated top line. So, right. So we get, let's see, the Fed launches QE1 here. There's more goodies. There's more threats. Officially threatening to expand QE1 dramatically here, and the market, quote unquote, calling the Fed's bluff, and the Fed having to deliver on that threat here. But before that, and people forget about this, this is hugely important. The organization in the U.S. that's responsible for promulgating or creating accounting regulations is the FASB. The U.S. Congress was threatening to make the FASB, or the people that worked for it, put them out of a job or something, but was threatening them in a pretty severe fashion, and wanting, what the Congress wanted was FASB to change the accounting rules for banks so that banks would not have to value the assets on their balance sheet, more specifically the troubled, toxic assets on their balance sheet, at what the market or mark-to-market was calling for. In other words, the same rules that everybody else has to play by, It was really inconvenient that banks had to do that, so they created, or they changed the accounting rules to allow banks, only banks, to value the assets on their balance sheet to what they thought would be a model, and many tongue-in-cheek referred to as mark-to-myth, but in any case, mark-to-model accounting for banks, again, banks only, were allowed to have this this accounting rule change. That was epic. That was dramatic. As you can see graphically, that stopped this the plummeting SPX in its track. It stopped the mini greedometer. Again, look at this. This is nowhere near mini greedometer reading this baseline. It's certainly nowhere near this one. Warped shallower, it's nowhere near this. So what that means is, it means absent that change in accounting rules, you should have expected the SPX to have continued plummeting far, far lower than the 600s where it bottomed out, to at least the 400s and potentially even the 300s, probably the next week to week after. Free fall for, another week to maybe two. That's what would have happened. But it didn't, because we got this accounting rule changed. The Fed following through, as I mentioned earlier, on expanding QE1. That basically put the nails in the coffin, and we blow it above the top line, and we would not have any amount of appreciable stress in the stock market until this graph told us that when to expect the next stock market crash. So let's see. At the end of this sequence, we started a clock. So when would the next countdown for a crash initiate? And most of you aren't aware of it, but looking back on it now, the May 6th, 2010 flash crash, where the Dow dropped 100 points a minute, was down about 1,000 points on the day before someone pulled the plug, and central bank liquidity managed to jam it back in the opposite direction. There's been a lot of that going on over the last year or two, but in any event, that crash was foreseen a few weeks before it kicked off. The mini greedometer actually went berserk, and readings rose dramatically. But that crash, we knew the launch point. We were expecting it from this graph. It should have been, and this is what, 48 or 46 or 45 weeks, knowing the launch point within a few weeks. Anyway, so that crash happened, and it was stopped by the Fed announcing QE2 at Jackson Hole, and I think it was August of 2010. That stopped that crash, and we had to wait for the next crash to initiate, and we had to wait this many weeks, according to this graph, right? So that was about 25, 30 weeks or so, and that's what initiated the 2011 crash, which again, the SPX dropped 20% that year, and you might say, hey, it wasn't a crash if it only dropped 20%. Well, it dropped 20% in a matter of weeks, and would have kept dropping had the Fed not tag teamed with the ECB. Anyway, probably more than I want to say, and this is probably getting a bit cluttered, but that's a great application of how to use this system. And how it is a dynamic system, how it changes with things that happen that the Fed says, and by the way, not just the Fed. If the ECB, if the BOJ, if the PBOX say or do things, they have an impact on the sequence as well. There are other videos on this website showing how the system works. And specifically, I know there's one that I did a while ago about the Fed taper tantrum, showing how that's great because it shows the baseline getting warped steeper and then flatter, depending on the Fed saying, hey, we're gonna begin tapering, and all of a sudden this gets steeper, and they go, oh, just kidding, no tapering, no taper. Then it gets flatter again. They get a kick out of it. Well, I did it at least. Okay, that's it for this one.